Hi, this video is going to be about inflation, what causes inflation, and other stuff like deflation and more like economic video. I had someone requested, so I've done my best to kind of put together this. Hopefully you guys will know a little bit more, and this is kind of extend to my knowledge. Of course, economic is its own kind of, I would say, discipline within business. And in my MBA class, this is the extent that I've gone through. I have not gone through deeper than this. So anything outside of this, guys, I would say do your own research. All right. So what causes inflation is a great question. Right. Before we get deeper in, I put in this GDP basically, kind of like how we measure our would be growth, right? National income GDP, right, is what is represented by Y. Consumption spending is by your C plus. So you add up everything and then you basically subtract your import versus export and government spending. That's real GDP number, right? If you wanna do kind of overall what economy is doing, okay? So let's dig in. What causes inflation? So inflation is a measure of a rate of rising price of goods and services in an economy. Inflation can occur when prices rise due to increase in production cost, such as raw material and wages. A surge in demand for production and services can cause inflation as consumers are willing to pay more for the product. Some companies reap the reward of inflation if they can charge more for their product as a result of higher demand for their goods. Okay, so let's kind of step back. I'm going to give you guys very simple example in this COVID-19. What kind of happened, right? Let's go one by one. Inflation is measured of rate of rising price in goods and services in an economy. This point right here is actually we as an individual do not have control over it. Okay, government has decided that US government has decided that they want to be somewhere around 2% benchmark for inflation. Okay, so there is nothing we can do to kind of, well, if you have cash, right, there are things you can do actually to, like, let's say you had $1, right, inflation will happen. That's kind of the whole thesis of this, right, or the current monetary policy that we have. Inflation can occur when prices rise due to increase in production cost, right? What does this mean? This means that the where you work, right, is the workers all of a sudden demand more money. Like, for example, at Amazon, right, the drivers that deliver your goods, they want more money. The cost of steel has gone up due to tariff or whatever reason, right? There are plenty of reason. If factory needs to pay more money to produce certain goods or services, right, they will charge more money, right? So that's kind of what it's talking about here, right? Such as raw material and wages, right? Surge in demand for production and services can cause inflation. Consumers are willing to pay. So this part is kind of, we kind of saw that with toilet paper and right, any cleaning supply when COVID happened. So you could have seen that people were just fighting over and paying, and people were hoarding, and like literally all of that is just supply and demand. Okay, at this point, some company reap the reward of inflation if they can charge, right? Certain company, like, they can just obviously charge more money because at that point this supply is less and then a lot more people needs to buy, for example, toilet paper during COVID-19, and we still on COVID-19, but we don't have this messy situation anymore. Okay, toilet paper to any cleaning item. So here's an example. I got it off Investopedia. It's a great website. Definitely look into a lot of these things I've gotten from different websites, obviously, because I'm not great at artwork and I need to reference stuff, right? They give an example of inflation. In 1970, you could have bought a coffee with 25 cents, but exact same coffee, by the time we hit 2019, which is 2 years ago, would have cost us $1.59. Obviously I was not around in 1950, 1980s, and so I kind of come here in around 1990s, right? So it's 75 cases, but if somebody did, right, so you can see in 30 some years, right? So in 2000, right, 1970 to 2000, 30 years plus this, so 19, so 50 years, right? In 50 years, right, 25 cents value really back then is now is $1.59. Okay, how does inflation work? Here's of course another example. Exclusive in sneaker, that was right before people lined up, they could have charged $100, and now they're controlling it so that the same store could charge $150 and people are still willing to pay. And you know, that's kind of the basis of it, right? Cost plus is that cost of producing certain item, like in this case the balloon, right, has gone from helium, right, that we put in more balloon, from $10 to $20. Therefore, if you were to buy a balloon for your birthday party or whatever, right, from $5 it would have got charge you $10 the store, because the production cost has gone up. This is another way of looking managerial accounting. If you guys looking into, want to look more into this, so building, right, the prices goes up and wages goes up, therefore, right, inflation kicks in, right, in order to maintain the living cost. All right, inflation can help actually borrowers, believe it or not. It does have positivity kind of associated, right? If wages increase with inflation, right, and if the borrower already owed money before the inflation occurred, and the inflation benefits the borrower, right, by this is because the borrower still owes the same amount of money, but now they get more paycheck to pay off their debt, basically. So it does have some benefit, right, in a way. This is why a lot of time when you go try to take a loan, right, you have two options: either get a fixed rate or the other one, which is like floating kind of deal with the market rate. Okay, so that's why. And a lot of time they don't want to give you fixed rate. They want to give you the market, right? This is kind of extreme example, but I wanted to throw that out there. Great Depression, right? In long term, deflation creates high rate of unemployment and can eventually cause consumer to default on their debt obligation. The last time the great world experienced an intense period of deflation that lasted for many years was the Great Depression, right? Keep this word in mind, Great Depression, because we will come back to it in some shape or form. We also have, is inflation worse than deflation, right? It's a great inverse, like kind of, if you have inflation, there could also be the deflation, right? Or it could be also hyperinflation to all of that. So let's look at what inflation, how is this correlate? Deflation, right, is expectations make consumer wait for future lower prices. So example is, I can wait to things to go on clearance, right? A lot of time, a lot of Asian or people who are price savvy, right? They wait. They're like, if I can wait, and then same thing is gonna go on sale, why not wait until then? That's the example. This reduces demand and slows the growth. Deflation is worse than inflation because the interest rate could only be lower to zero. Right. Example is a Japanese citizen responded by saving more money and spending less, right, and had a negative impact on aggregate demand. This contributed to deflation pressure that encouraged the consumer to further hoard money, which resulted in deflationary spiral. So it's kind of a great example if you wanted to take a look at what is deflation, what is inflation. Kind of we have a live example from Japan as we speak. Here is a Somali exchange right now, right? This is actually, it does happen. They have a, I think it's some kind of market, right, where money exchange is happening, and there are a bunch of vendors, right? They are sitting with their money, and with $1 or whatever, right, you could buy that much money. So this is how this literally, there's a they're just selling you physical printed out note. It's kind of crazy, but yeah, people are sitting on the side of the road selling money for different exchange rate. Right, hyperinflation in Venezuela. This is another example. This one in the picture I found that it's cost of tomato, right? This is how much money you would need to buy just this many of tomatoes, right? The two primary causes of hyperinflations are A, increase in money supply, right? Keep this one is very in mind, money supply, and not supported by economic growth. Keep this also in mind, which increases the inflation, right? These two are very much is kind of like go hand to hand, right? If you increase the money supply, there needs to be economical growth. Otherwise, you'll kind of run into hyperinflation, which is currently in Venezuela. Demand pulls inflation, which then demand surpasses the supply, right? So basically, what this is saying that look, our demand, right, it goes higher, but money supply is like just crazy amounts of money supply. How do we measure inflation? Well, we don't really technically measure as a consumer. It's actually government's job. Every government measures this. In United States, they are calling it CPI. Basically, it's a basket of goods and services that a normal person, right, would need to kind of sustain their lifestyle. An example here is, right, we need housing, we need foods and non-alcoholic beverage, we need recreational and cultural activity, we have to have transportation, right? We have to have some kind of furniture in our house, right? Alcohol and tobacco, some people like that or some people don't, but we still have to measure that. There's a healthcare need that we have to measure, the insurance and financial services, right? Education, clothing that we wear and footwear, right? And communication is kind of like a good example, and they also giving you like what percentage kind of effect. So if you're very curious about, take a look at CPI basket. They will give you how the government comes up with the number. Right now, US is trying to have about 2%. Is what they're hoping to have. Okay, at inflations. Controlling inflation. Okay, what the government. Any government has basically two things: is monetary measures and physical actually measures. This price control really, unless you are, well, it does some countries, right? You could have price control, but that doesn't really work in free market and in capitalist economy actually. So I have given you, I'm giving you a little bit example going off the gold standard. So those of you, if you didn't know, right, United States money was backed by gold standard, but they eventually took out. Going off the gold standard gave the government new tools to steer the economy. If you are not tied to gold standard, you can adjust the amount of money in the economy if you need, right? You can adjust the interest rate. Almost all economists agree the system we have today is better than gold standard, right? If you look at basically one of the problem was, right, the supply of the gold, right? If you had a lot of gold, then you're screwed, and the government couldn't really control that. So as in 1971, right, government basically decided to let's stay away from that, and we have now ability to print our own money. It's just basically IOU more or less. Okay, here's just another representation of what the tools that is available. Fiscal policy and monetary policy, keep this in mind. Fiscal policy comes into either spending a lot more money and then charging us less taxes, or vice versa, versus like interest, right? Monetary policy is like how much money is government is charging, right, this, to lend out to commercial banks, and then how much money do we have in supply. These two makes up basically the government policy. That's all they can do. Okay, monetary policy is, in monetary policy, the central bank increases the rate of interest on borrowing for commercial bank. As a result, commercial bank increase their rate of interest on credit for the public, right? Because if it costs more money for banks to borrow, therefore it makes more sense, right? They have to make profit, right, in capitalist country, and then whatever we go and borrow the money, right, it will cost us more money. Such situation, the Such situation, individual prefer to save money instead of investing, right? So as soon as we have this problem, right, people are saving money, then we have other issue which I gave you with Japan, right? This would reduce money supply in the market, which in turn controls inflation. Okay, so this is monetary way. Apart from this, the central bank reduces the credit creation capacity of commercial banks to control inflation. All right. So the goal of monetary policy is generally around price stability. They don't like this high fluctuation, high employment. Government really wants people to be employed. Economic growth, right? We want to be always in growth cycle. Stability of financial market and institution basically is divided into three more, which is stable interest rate, stable exchange rate, healthy banks, right? This is very important because if you don't have a stable interest rate, then nobody wants to do business with you because you don't know at what rate is tomorrow or today and when, and then everybody's confused. Stable exchange rate because you want to be predictable, right? A lot of countries have problem with this monetary policies. If you look at it, where exchange rate is just crazy, right? Monetary policy goal, right, is control inflation. All right. Economic growth, price stability, reduce unemployment, regulate currency exchange, and social welfare. That's kind of main objective of our monetary policy, right? And this side, this is all dealing with inflation. Okay, economic growth, price stability, all that good stuff. So now let's look at the fiscal policy. Fiscal policy tools are used by government that influence the economy. These primarily include changes to level of taxation and government spending. To stimulate growth, right, taxes are lowered and spending is increased, right? Kind of if I'm working and I'm paying less tax, therefore I have more money in my bank checking account, therefore I'm more likely to spend those money, right? This idea is all dependent on consumerism. Remember, United States or most of the capitalist country, right? Everything is dependent on consumerism. So this is why often involve borrowing through issuing government debt, right? To put that damper on overheating economy, an opposite measure would have taken. So basically, where did it go? I'm sorry. Government spending includes the purchase of goods and services. For example, fleet of new car for government employee or missile defense system, right? Government spends. Basically, government goes on a spending spree in this fiscal policy, and in often time, basically, you have to have both monetary and fiscal policy in order to really have the good balance and healthy growing economy, controlling inflation, and then government also needs to be spending. Government also needs to basically not charge too much money to the banks, so therefore we don't have to, right? Cost of borrowing money is not too expensive, but at the same time they don't want to charge too little, otherwise, right, inflation would be out of control. Like this, kind of like a healthy balance that needs to kind of figure out. Can inflation cause a recession, right? So let's see. Inflation is not the main cause of recession, okay? Usually, recessions are caused by factors such as higher interest rate, which we just talked about, right? If government, their fiscal policy is that they're going to charge more money to the bank, therefore it's going to come, it trickles down to the lower guys paying more money, fall in confidence, fall in bank lending, and decline in investment, right? If we can't get money, therefore we won't be spending, therefore we won't be investing, right? All that. However, it is, because that cost push inflation can contribute to recession, especially inflation is above minimum wage. So this is all it's really saying is that, look, if minimum wage is good, right, the normal wages growth, right, we should be fine somewhat. All right, so current US inflation rates since 2017, 18, 19, 20, right, 2.1 in 2017, 2018 was 1.9, 2019 was 2.3, right? As you all know, in 2019, just before everything happened, right, government we actually were in growth phase, like everything was growing, booming, like people were like, oh my god, what if we had boom and bust type of deal, right? Are we in kind of hit another bubble and so on, right? So this is kind of in 2020 is 1.4. Everybody was employed. People had a hard time finding basically people, right? You could not cheap, but it's still decent amount of interest rate could have got. So I'm gonna kind of shift a little bit to kind of give you guys more in higher level view and how money really kind of has evolved, and then hopefully we can tie this in. Like in the past, right? Here is an example where how money, basically different ways money was used, right? People used to trade alcohol, right, instead of printed out money, okay? There used to be some time ago cocoa beans. People actually traded just like a commodity. So these are commodity money rather than paper form money, right? Coppers, which means that metal, right? Gold, same thing. Right, gold, most of you are familiar with it or somewhat heard of it. Salt and seashell, right? You could have gone in the sea and then collected a bunch of these. You could have been rich. We have silver at one point. We also had tea. Believe it or not, we also actually had tobacco. So it's a form of money in the past. So over time, government really has gotten away from that. Gold standard is basically US and gold standard in 1934. US government fixed the price of gold to basically 1 ounce for $35 per ounce, right? The US then confiscated all of the previously owned gold, and then US quarterly exchanged fiat currency for gold. All right, this is effect took in US after gold standard. The US continued to fix the price of gold $35 per ounce until 1971. That's when they took out. So Roosevelt cut the dollar ties with the gold, allowing the government to pump money into economy and lower interest rate. So this is very important. The reason I brought this up, because if you look at it in this kind of our commodity exchange, we never had this problem. This is really, this entire problem is a new situation because we are in growth, healthy economy, and this inflation is a basically byproduct of, it's like having electricity, having light, and right, byproduct is kind of heated lamp, right? Because it does produce heat. So it's that's kind of this is why I put there. Most economists now agree that 90% of the reason why US got out of Great Depression was because break with the gold, right? By 1971, it was official. The dollar would no longer be defined by gold, thus making the end of by any semblance of gold standard. Right, next then basically 1971 directed control of US dollar into gold. Okay, here's the evolution of money. Basically we had barter, which is barter system, right? I'll give you 1 cow for, let's say 2 gold or something like that, right? That's before the money. Then came gold money, right? Then we have metallic coins. And right now we are in basically paper money and this plastic cards, right? This credit card. Now the newer one is the electronic money / cryptocurrency. Is basically evolution is happening after cryptocurrency, right? I don't think none of us is gonna be alive to really know what's gonna happen. However, right, this cryptocurrency or this electronic, right, eventually should be a little bit more stable, right? The money basically is over time, right? Different money is introduced into our system with different reason, right? To solve very specific problem, right? And then there's always a byproduct at the end, which none of us knows and why, right? Is a problem. The investment to do well historically against hyperinflation, right? That's kind of what we are worried about, right? What if my money is no longer worth much, right? When I retire, what do we do, right? Means that they leave you entirely immune to inflation price, right? What you can do is basically buy a bunch of real estate, right? Maybe real estate has its own science, its own art. So do your due diligence, right? Location, and location. Real estate, commodities, right? Have some commodities, gold and precious metal, right? Invest in a little bit of those, right? There's no guarantee. Investment grade art, right? The rich people love to buy a bunch of art, even though they may or may not know what the hell they're buying. But right, it's very highly subjective. Right? But they do that because they want to hedge against inflation. That's a good way to do it. Treasury, inflation protection security, right? There's really bonds and stuff. Growth oriented stock, right? Buy a bunch of stock that just going crazy, like Tesla. Cryptocurrencies right now is the newer form of hedging against kind of hyperinflation, right? Buy Bitcoin if you have money. So this comes up to the last question: will inflation go up, right? Because we have so much money printed injected into the system. What is this impact? So if we go and look at our basically thought process, right? Economic growth, I think what is this? Interest rate, money supply. This is monetary supply, right? What monetary supplies is deals with the price stability, right? Higher employment, economic growth, right? Stable interest rate, all of these. So therefore, yes, we will have higher inflation rate as a result of this. In past, it used to be right around 2%. I think in the future, it is safe to say that the more money that we injecting and we're not doing any type of more or less right, production of anything, right? Because if we look at example from Venezuela, right? Here I gave you guys very specific, right? An increase in money supply and not supported by economical growth, right? We don't really have economical growth, right? What we doing? We just pumping bunch of money, right? Therefore, the demand of things will go up if we do not have economic growth, right? That's what government hopes. But all of a sudden, giving people money, right? I don't think it's gonna just overnight be gonna happen. In short term, we should see some inflation, right? I don't know if it's gonna have hyperinflation like Venezuela, but we will have inflation, and I don't think it's gonna be same as in the past, because now people are gonna demand more money. I'm gonna demand more money from my worker, basically my employer, right? So the cost of doing business for them is going to go up. Therefore, they will trickle down to the other people. All right. So I hope this kind of gave you good insight, and this was kind of my thought process. All right, guys. Hope you're doing well and staying safe. And talk to you later. Thank you.